Hey everyone, it's Lewis back again with another video, and if you're keeping score, this is part 2 of the entire Investing for Beginners guide. In this episode, I'll be going through exactly what is listed on a stock market, from individual companies through to commodities like gold and silver. This video will show you exactly what you can invest in on a stock market. I'll also go through some examples of each investment vehicle mentioned and dive a little into the 10-year average return of some as well to give you a bit of an inkling into what they can do for your money. Before that though, if you haven't already, make sure to go and watch the first episode to this guide right here, which provides a general guide into what a stock market is and what it isn't. And if you're new here, please make sure to give the video a like and subscribe to the channel in order to keep up with a new release to this guide every single week and amongst the other videos that I'll be posting in the future too. So then let's get into it. So you can invest into many things in the stock market. It's not just individual companies that everyone talks about like Apple, Google and Tesla. There are also entire funds of companies all put into one basket known as an ETF, and also things that are entirely unrelated to company stocks such as commodity trackers and real estate investment trusts. So number one, it's good old individual companies known as stocks and shares. Now, first of all, stocks and shares are the same thing, but they're different. For simplicity, if you were to say, I have 100 stocks, that generally means that you have 100 companies within your investment portfolio. You could then have 100 shares of company A and 10 shares of company 100. So the stock is the company and a share is a piece of that company. For every share that you have, you literally own a piece of that company. For example, if you buy just $1 worth of Apple, you literally own $1 worth of the company Apple. And that $1 has every right to gain from the revenue and profits of the company for as long as that $1 is invested. That's just as much of a right as however many shares that Warren Buffett owns of Apple. You and Warren might own drastically different amounts of shares within the company, but you still gain the exact same return on investment for each year that you own the company. Like I said in the first video to this series, Apple or any other company's stock is not a lottery ticket. It's not going to get you rich within 1 year, but over 30 years, it could make you incredibly wealthy. So this is what the majority of stock markets are made up of. Companies that have listed publicly in order to open themselves up to investment from anyone in the world who has access to money, the internet, and a brokerage account. There are two types of stock that individual companies can offer. That is common stock or preferred stock. Now, common stock is obviously common. It's what you'll find listed on public stock markets for the everyday retail investors such as me and you. Preferred stock is what directors, CEOs, etc. will earn from payment packages and so forth. This is because preferred stock is granted different rights from common stock, such as the right to having higher dividend payments. There are also two types of companies when it comes to individual stock investing: growth companies and value companies. Generally speaking, growth companies don't tend to offer a dividend, which is a certain percentage of each share that is paid out to investors in order to share the revenue growth out to each investor so that you can earn some passive income from simply owning the stock. Instead, the mission of growth companies is to aggressively grow their revenues each and every year. And in order to do this, they reinvest the majority, if not all, of their revenue straight back into the business and forego paying their investors a dividend. So you won't earn any passive income from owning a stock like this. However, the money that you hold in these stocks over several years will generally grow a lot more than a value dividend stock would. But as a warning, on the flip side of that, when or if revenues fall for these types of companies, the stock price will fall much more rapidly than that of a value dividend company. So they are more riskier, but like they say with risk, the greater the reward can be. Two great examples of this are Google and Apple. Over the past 10 years, the average return on investment from owning Google stock is 26.73% thanks to their aggressive growth model, which is pretty damn amazing. Apple are the same, however, they actually now pay out a very small dividend, so they could be considered a bit of a unicorn in the world of investing. a growth company that pays out a dividend. But the important thing here is that they are still considered a growth company, and the average return on investment on Apple stock from the past 10 years is 30.20%. An investment into both of these companies alone would have comfortably beaten the S&P 500 over the same period of time, which only returned 14.84%. Value companies, however, trade for much less than what the intrinsic value of that company is. This is the type of company that Warren Buffett mostly invests his money in order to beat the market each year by quite some distance. These are usually much older companies that have been around for generations, who are absolute giants of their respective sector, the biggest companies in the world, such as Coca-Cola, Visa, and Johnson & Johnson. These companies pay out that aforementioned dividend to their shareholders as a thank you for owning the stock and investing in their company. And a great example of this is Coca-Cola. Over the past 5 years, the average return investment for the stock price of Coca-Cola has only been 8.94%, but it's the dividend yield that makes it so attractive. Right now, for every share of Coca-Cola that you own at the time of recording, you'll receive $1.76. That's a dividend yield of 2.79%. Not only that, but Coca-Cola are one of very few companies listed on the US stock market that are considered a dividend aristocrat. This is a group of companies that are within the S&P 500 and have had to increase their yearly dividend payout over the last 25 years minimum to be considered an aristocrat. For the record, Coca-Cola has been increasing their dividend each year for the past 60 years. So if you took that yearly increasing dividend payout into consideration each year over the last decade with the stock price rise, the total average return would be a lot more than just 8.94%. Think of this as effectively a high-interest savings account in which not only the principal can grow each year, but so does the interest rate. This is compound interest at its finest, and it will do so much more for your money than a traditional savings account will. However, I have to say that investing into individual stocks is very risky. I'm not going to say to not do this because it's everyone's own choice, and it can be somewhat fun, interesting to do, and is a fantastic learning experience for any investor. However, if you want to buy individual stocks, here are a few suggestions that I'll make. Remember, this isn't financial advice, this is just what I literally do. Number one is simply to stick with what you know and figure out what your circle of competence is. What is circle of competence? Take it away, Warren.
And the trick in investing is just to sit there and watch pitch after pitch go by and wait for the one right in your sweet spot. And if people are yelling, swing you bum, ignore them. There's a temptation for people to act far too frequently in stocks simply because they're so liquid. Over the years, you develop a lot of filters. And I do know what I call my circle of competence. So I stay within that circle, and I don't worry about things that are outside that circle. Defining what your game is, where you're going to have an edge, is enormously important.
So effectively, circle of competence really should be what you know. If you work in a certain type of sector, maybe it's financial services like myself, or maybe it's retail, then you really should be looking at companies that are within this sector, especially the company that you work for. The same thing can be said for things that you use on an everyday basis. Now, of course, you might not work for Apple, but you might use a lot of Apple's products and/or services. You might have an iPhone that is connected to iCloud. You also might own some AirPods and you listen to music through Apple Music. You might also own an iPad and a MacBook Pro. Chances are, if you are fully ingrained into the Apple ecosystem, you know exactly how Apple is making money. Why? Because they're making that money off of you. If you know exactly how that company operates and works, and more importantly makes money, then again, it really is something that you should be looking into. If you work in a sector such as retail though, don't look at pharmaceutical stocks, and the vice versa. If you work in pharmaceuticals, don't look at financial services stocks. You won't know what they do and how much money they make and how they make it. And my second suggestion is only allocate a small percentage of your overall investment portfolio to this. This is simply in order to keep the risk of losing any money in stocks that you had a good feeling about, but it didn't quite work out, to a minimum. Because let's be honest, even the best make mistakes. Warren Buffett made a mistake with airlines, and Bill Ackman made a massive mistake with Netflix, etc. Sometimes, no matter how good or undervalued a company might look, It can just be that it's not a very good company compared to its competitors. Now, that's not me to say that airline companies or Netflix aren't great companies. However, that's definitely the case with some stocks that you might have been attracted to that just didn't perform up to your lofty standards. In order to mitigate that risk, I would honestly only keep a small percentage of my portfolio open to individual stocks, with the majority simply matching the market in ETFs or index funds. And that nicely leads me on to ETFs, or exchange traded funds. ETFs themselves trade like a stock, but are actually made up of an entire basket of companies. There are institutions that create these ETFs, such as Vanguard, BlackRock, and Invesco. These companies have cornered the market on index funds or ETFs, which offers investors like you and me the opportunity to buy several hundred companies all at once for a very low cost. For example, Vanguard provides an S&P 500 ETF here in the UK, and the stock ticker is VUSA. This ETF is made up of the 500 biggest companies in America and trades for only £66.26 per share at the time of recording this video. Compare this price to how much it would cost you to buy just one individual share of every single company in the S&P 500, it would be in the tens of thousands. However, since VUSA's creation in May 2012, the average return on investment has been 16.85%, which includes the return from dividends received, as this ETF does pay out a dividend. The reason why this ETF does that is because it owns companies that do the same. So any ETF that includes dividend-paying companies will provide you with a share in that as well. There are actually quite a lot of very high-paying dividend ETFs just because people want to invest in something very passively that pays them simply for owning that little thing. For anyone who just wants to invest in the stock market but not look at any company balance sheets and listen to earnings calls and calculate the intrinsic value of an individual company, ETFs are the place to be. You don't necessarily have to do anything other than consistently buy the ETF every month and see your money grow exponentially more than it would if it was in a savings account. And simply matching the market with these ETFs ensures that you'll be beating the majority of professional investors who try to get greater returns than these ETFs do. Professional investors, funnily enough, overwhelmingly lose to the stock market. According to research from 2020, nearly 90% of actively managed funds failed to beat the market over a 15-year period. Therefore, it's highly unlikely that you'll succeed where they failed. Another thing that you can buy on the stock market is real estate. This is through something called REITs, or real estate investment trusts. Now, this is a very reasonable investment strategy for anyone who wants to be a landlord without having to actually be a landlord, and again, is a very sound passive income idea. A REIT is a company that owns, operates, and or finances income-producing real estate. This is the likes of shopping malls, corporate office buildings, apartment buildings, hotels, and warehouses, etc. The growth from the value of these buildings and the rental income that they generate is passed on to the investors, such as me and you, if you own them. For the record, I don't. The rental income is paid out in dividends, and with REITs, it is literally the law for at least 90% of the profits made from these trusts to be distributed back to shareholders as dividends. Because of this law, the stock prices of REITs doesn't go up or down anywhere near as much as company stocks or ETFs may do. However, that's not what they're designed for. They're really here for the dividends alone. The biggest REIT in the world is American Tower, stock ticker AMT, which has a market cap of $121.6 billion. They own/operate 220,000 sites globally and is a global leader in wireless infrastructure such as 5G towers. There's also companies like Big Yellow Storage here in the UK, which is considered a REIT, which you may have heard of. Then there are commodities, or more specifically commodity trackers, which are called exchange traded commodities, or ETCs for short. This is literally like an ETF would be for stocks. This is for people who want to maybe diversify their portfolio a little to get exposure to things like gold, silver, platinum, clean energy, oil, timber, you name it. If there's a commodity that exists, chances are you can buy an ETC that will track the price of it. Like I said, the main reason for wanting to do this is to diversify your portfolio just a little bit, or you might be an expert in a certain commodity, Perhaps you're in the timber trade, for example, and you spot an opportunity to buy into it at a lower price than what you think or know it's worth.
It's going down.
Other than that, to be completely honest, sticking with stocks for the majority of your investing is the best way to grow your money. Honestly, commodity investing is mainly for wealth preservation, not necessarily wealth building. Take gold, for example. It's a great hedge against inflation because it holds its value much better than what a stock would. If the overall economic environment isn't good, with high inflation about, or a recession, or both, then stocks will tend to go down quite dramatically. Commodities don't do this as much because they're a much more safer bet during a downturn. However, they can completely go the other way, so they do have their own risk. Oil, for instance, has had a roller coaster of a price cycle since the pandemic, and in fact for the last 10 years really. There has been some wild price swings with oil, with a low of minus 45.55% return in 2014 to a high of 55.01% in 2021. And people thought crypto was bad. This roller coaster of an average return over the last 10 years has returned all of 2.54%. So really, is it really worth it for that massive roller coaster of emotions for 2.5%? I don't think so. Unless you're an expert on this stuff, personally, I wouldn't touch it. I guess also you have to consider the ethics of investing into commodities. Obviously, if you don't believe in oil, if you think it's destroying the planet, then you probably shouldn't be investing into barrels of it in the first place. So there we have it. There covers what you can get in the stock market, and as you can see, there is quite a lot. Now personally, I only own ETFs, some individual stocks, and a tiny amount of ETCs in gold, and some clean energy such as wind and solar power. I don't go anywhere near anything else because it's out of my circle of competence, and when it comes to my individual stock holdings, I only stick with what I know. For me, that is the financial sector, more importantly the financial services sector, consumer tech, which I've been using myself personally since I was about 7 or 8 years old, and crypto. If you do the same, stick with what you know, or invest passively into ETFs, chances are you'll do very, very well with your investing. Overall, this video was made to not only let you know what you can find in stock markets, but to make you go away and think what it is that you might want to be investing in and sticking with it for decades. What do you think you'll go for? I'd love to know, so let me know in the comments. As always, I really hope you found this video useful and helpful, and if you did, do give it a thumbs up, let me know your thoughts about it in the comments, and consider subscribing if you already haven't. Stick around for the next video in the series, episode number 3, where I'll go through how time in the market beats timing the market with investing, and I'll show you some examples of that. So stick around in the next one. And remember, until next time, every quid counts. See you soon.